Hello and welcome to financialectors.com and to this exclusive panel from Deloitte to dissect the budget 2025. I think there's a lot of excitement around this budget because as we were expecting, it is a budget that is consumer focused and as we were calling it a pocket booster budget. It does put a little bit of money in the consumer's pocket, and I think that is what was needed to give the entire economy a push, pushed up the economy with a little more spending power to the great Indian middle class, something that we all said was ignored in the last budget. And perhaps she has made up for it, or perhaps not. That's what all of you here would probably tell me. So I think let's start with the big headline of the day, of course, because it's for consumers, the 12 lakh limit for tax-free income. I can go straight to Sudhakar for that. Sudhakar, was this expected, this kind of raising of the income tax limit?
Yeah, I would say that to some extent there was an expectation, but absolute quantum has been a subject matter of deliberation as to how much the increase will be. And one more point we need to remember is that the finance minister said about the new income tax bill. And if you recollect the old direct tax code when it was introduced in 2010, it proposed for a significant increase from a threshold standpoint insofar as exemption is concerned. So given all this, I think it's a great boost for the Indian working class where they don't have to pay any taxes almost on income up to 12,75,000 rupees. So it's that way, it's an amazing thing.
Okay, so that is a little bit more money in everyone's pocket. Of course, if your income is above 1275 for the salaried class or above 12 lakhs 10,000 maybe for the business professionals, you will still come in the tax bracket. But she has changed the tax slabs as well, right? She's played with the tax slabs as well. Will that impact the government in a big way in terms of their revenue collection?
Yeah, I think not just this 12 lakhs limit, they have also increased the tax slab per se, right? So today we are talking about rates starting with 5% and going all the way up to 30% on income above 24 lakhs plus. So what this actually, you are looking at a savings erosion of about approximately lakh and 25,000 rupees approximately on income for people under the new tax regime in the current status of law vis-a-vis the budget proposals. So this is going to have an impact on the economy because if you see the finance minister, when she closed the budget, she said the direct tax and indirect tax proposals are going to cost her about
1,000 crores.
lakh crores,
Yeah.
right?
1 lakh crores and 2,600 crores in indirect taxes.
Correct. So it is going to have an impact. I would say that this as an investment by the government in terms of its people, because when they framed the budget, the objective was very clear. They spoke about agriculture as one of the focus areas. They were actually drawing to the basics. They started off with agriculture. They started off with the youth in India. And this, I would view it as an investment by the government and the people of the country, and from a long-term acceleration of this economy and contributing to its growth. That's how I would see it.
Okay. Rumki, if I was to come to you, how would you look at the budget overall in terms of, boosting the economy? One, from the perspective of, in recent times, we have seen in the stock market at least, FIIs have been pulling out and there's not much investment coming in there. And on the other hand, we also have this whole Make in India movement, which probably incentivizes domestic manufacturing more and maybe not so much in foreign investment coming in. How do you see her playing a balancing role in this budget?
Thanks, Roshan, for having me over here. I think the budget has focused on some of the key issues that India has been facing. One is that consumption that we need today, especially at a time when global uncertainties are high, when we know that there could be challenges coming from on exports. We need to boost our domestic demand, and consumption is pretty much 60%, 61% of the domestic demand, and that's where we needed that push. So that's what was one focus, and they have done that. Second is inflation, which has been a persistent problem for the last 4-5 years, because barely 3 or 4 months in this 5 years that the inflation has come down below 4%. It's been always above that.
So it was 5.8 last month. Yeah. 5.8% last month. Yeah.
Correct. So and a large part of it is because food inflation. So especially pulses, and that's where they went about focusing on pulses, ensuring the food supply chain is managed. So again, inflation was the other part. Third was the focus on employment. Again, a big ask from the market analysts that we need employment, especially that we are a populous country. So for boosting the MSME sectors, even startups, all these are measures that clearly says that we need employment, and also in the AI space, because they kind of focus on health, AI, etc. So very holistic perspective is what I see here. And of course, they have continued with some of the other ones. So the capex, one can say that the capex spending was lower than what we would have expected. But given that we have a backlog to make up for, and then they have about 10% higher than what we will reach this fiscal year, kind of shows that yes, the government has continued some of the policies, but also reinforcing some of the major concerns that India is currently facing now.
Okay. A lot of proposals on the indirect tax front as well. I'd like to bring in Hardik over here. A lot of focus on the indirect tax front, a lot of changes in basic customs duty on a lot of electronic goods and things like that. Again, with a focus on Make in India. So you think that's also going to give the economy the push it needs?
So absolutely right, Roshan, and thank you for having me here. So proposals from customs have been largely with an objective to rationalize the tariff structure, address any duty inversions, and also support domestic manufacturing, value addition, largely promote exports and even facilitate trade. Last but not the least, also to provide relief to the common people. Now, if you see from more of a sectoral changes where the duty rationalization has been done, let's say for instance for healthcare, now there are about 36 life-saving drugs and medicines which are added into the list of fully exempted from basic custom duty, and some other 6 life-saving drugs where the duty has been reduced to just about 5%. And more importantly, there are any drugs which are used for manufacturing all of these products are also fully exempted from custom duty. Then we talk about EV manufacturing. Now, there is a big list of capital goods where close to about 35 capital goods which are used for EV battery manufacturing, 28 capital goods which are used for mobile phone battery manufacturing are being exempted from custom duty. Now, I'm sure this is going to boost the lithium-ion battery manufacturing both for mobile phones and for electric mobility. And other than that, there are certain other critical minerals such as cobalt, waste, lithium-ion battery, lead, zinc, etc. are also being exempted from duty. From a textiles point of view, if you see a lot of textile products such as agro-textiles, medical textiles, and even geotextiles, which are at a competitive price, are also being reduced. And 2 types of shuttle looms are also being made fully exempted from custom duty. So a lot of rate rationalization has been done, obviously to give push to the Make in India and with the vision of Viksit Bharat 2047. And lastly, while we had expected, let's say, for example, customs amnesty or some clarification about on the inbound manufacturing, while those are not there, but overall, I feel it's a quite balanced budget from indirect tax standpoint.
Right. Okay. Coming to the manufacturing side, if I was to bring in Easwaran here, we expected more announcements on the PLI schemes in this budget, but there was none really that she focused on the manufacturing side. What do you make of it?
So 2 things. I think, the outlay, I was just going through the outlay on major schemes. I think for all the PLI schemes which have been announced, I think the outlay is still on. For example, the semiconductor, another 7,000 crores and stuff like that. So I think the new PLI schemes have not come, but I just go back to what Rumki said. I think what they have done is really triangulated a lot of aspects towards Viksit Bharat. First one is obviously focusing on the labor-intensive sectors. So we have leather and footwear, we have toys, and we have food processing. On together, all 3 of them can potentially generate roughly about 1 million of employment, right? So that's one excellent area that they have worked on per se. The second one is the National Manufacturing Mission. I think one of the aspects that I see of the National Manufacturing Mission, and if it really delivers on what we are looking at, first thing that it should really do is to reduce the variability between multiple states on ease as well as on cost of doing business, which means that as a country, we'll be able to get in the investments as anchors from global investors without really worrying about a concentration of manufacturing investments in multiple locations. So I think that's an outstanding way of looking at things for diversification of our manufacturing footprint. So just more than the PLI, I think this can really accelerate ease, cost, and speed of doing business. The third thing I think which has also been built in is also on the energy side. I think I go back to also what Hardik said in terms of sectors of focus on clean tech. So what this is doing is that with measures like CBAM coming up in Europe, focus on clean tech will really ensure that we are able to enhance our global value chain participation, especially on all the technologies that have been listed, be it in terms of electric mobility, be it in terms of, let's say, clean energy, etc. And finally, the last thing I think they've worked on is really the investment friendliness index. I assume it will replace the BRAP. But I think these are four things. So while the PLI itself as a subsidy or as a grant has not come in, I think the enabling factors have come in really well. I think one unnoticed factor is, I think if you look at the outlay for railways all over for 25-26, it's over, I think, about 2.5 lakh crores of rupees or so. So I think there is a substantial outlay on railways, which is also there. So to that extent, a lot of logistics play still in the mix, although not called out very specifically, but in the multiple areas. So I would say that PLI itself is not addressed, but a lot to do with India's manufacturing competitiveness and export competitiveness is addressed.
Right. She did mention some of the tax incentives for manufacturing for railway coaches, for example. She did mention.
Yeah. So there is enough focus there.
Right. I'd like to bring in Jimit also here. He's joining us. Direct taxes, again, this time a lot of tax tweaks. I mean, on the personal tax front and on the direct tax front. I think that's what's largely making headlines today with this budget.
Yes.
And like we were discussing, it's all about, boosting consumption. And so here as well, a lot of changes and rationalization on the TDS and TCS limits. What do you make of those? And for example, just to give you some example, for example, she said, TCS on remittance under the LRS scheme, where the threshold goes from 7 lakhs to 10 lakhs, and removing TCS on remittances for education, but with the caveat that if you take a loan from a certain certified financial institution only. So all of these come with these little caveats. So what do you make of it?
No, so this was very, very much expected because, if you look at the scheme of things, while the intention of the government when they introduced the TDS provisions was not necessarily only to garner revenues, was to track the incomes, typically whether the recipient is offering the income for tax or not. And that is why the 1% rate, 2% rate and everything was basically only for tracking mechanism. If you see the limits which were decided of 5,000, 10,000 and all such limits were decided years back. And practically, there was certainly a need to revise those limits considering the inflation and the fact that these limits were revised years back. And that is why it was but obvious that practically almost everybody were forced to deduct TDS on almost all kind of payments considering the limits. And that is why the limits have been extended. And see, on the TDS and the TCS thing, practically for all, it's actually a good measure of ease of doing business because if you look at it, all the companies had made a representation that it becoming too much complex. One person is deducting TDS, other person, whether it to deduct TCS or not, is becoming a practically logistical nightmare. And from the company's perspective, that will certainly help. Ultimately, government is saying, and they represented to the government that, what do you want? You want to ensure that it gets tracked. Now, if one person is deducting TDS, it is automatically getting tracked in the other person's hands. Then why do you need a TCS? Your objective is getting achieved. And that's why they did this mechanism.
Yeah, she did mention that, the updated return facility, 90 lakh taxpayers voluntarily updated their incomes. But she didn't really tell us by how much, how much more does the government get in? She didn't mention that figure.
Yeah,
Just the
no,
number
no.
of people that did it.
Yeah, absolutely. See, I'll tell you, I'll just give you by way of an example on the updated return, what has happened. Typically, see, this, many a times, sometimes, genuinely you have done some mistakes and you want to revise your returns. You don't get an opportunity to revise those returns once your due date has been passed away. Especially what had happened is the erstwhile few years back, the timeline for revising your returns was actually after a year or two. So you could have still revised it. But now with the timeline for practically of revising the return was almost December, practically you didn't get a chance to even revise the returns. And that is why many of the companies were actually, in spite of realizing it themselves, that oh, they made an error, who wanted to pay the taxes were not able to pay the taxes because they were not able to update the return. And that is why this provision was brought in 2 years back, where they said that, okay, you can revise it. It's indirectly like, it's like an amnesty scheme that, okay, you pay after 1 year, realizing we pay collect another 25% extra because it was not that you were going to pay only 100% of the taxes. You were paying 125% after 1 year. If you pay after 2 years, it was 150%. Now, what they have done is they have realized this and they have extended this to 4 years. The third year and the fourth year, but these amounts are not 25 and 50. The third year is 60%. That means you pay actually 160% of the tax and 170% of the tax in year four. But still, people might still go for it because if you are genuine error, even if you have clearly made an error, might as well pay the tax so that you don't have to face the scrutiny of the government and you don't have to pay penalty. Because if you voluntarily are going to pay updated return and paying the taxes, practically you then, you will be at least safeguarded from the penalty. If you're paying 160, 170%, even after 3 or 4 years, that will still be better as compared to paying a penalty of 200% because it will be treated as misrepresentation as such. So it is still a good measure, but the old caveats still remain. That means while this upper limit is now 4 years, you still, if a notice is issued to you in between by the department, then the option of updated return is not available to you. Whether it's a notice of assessment or a reassessment, now they've extended to reassessment as well. So if any notice of assessment or reassessment is issued, then this updated return option is not available because then, of course, the government has detected it that you have made some error. This was for a voluntarily detection and not by the detection by the government. So that's what
so
the
it's basically fastest finger first over here. If you if you spot the error, you do it first. But if they do it, then you can't.
Then because see, then government has found it, and if government has found it, they will want to do it even levy penalty. Here it is you yourself realize that you have made a mistake. So it's like that is why they say voluntarily. So if you have realized it, then you should revise your return.
Right. Sudhakar, you wanted to add to this.
Roshan, just a point I want to add, because this is a welcome measure aligning with the government's, proposal that trust first, scrutiny later. I'll tell you the reason why. In case of individuals who had overseas stint, right? Normally, I have come across or seen cases where they might take a call on disclosure of overseas income like interest or dividend from a materiality standpoint. Unlike in the Income Tax Act, we don't have that concept of materiality. So what happens is today under the Income Tax Act, you have penalty and interest, but there is an added element to it from the Black Monies Act, right? So where you start with ₹1 million of penalty even for few thousands of taxes which is not reported. So individuals can make use of these provisions and then try to address issues, especially in the context of any financial aspects they have overseas, which is not reported or which is not disclosed and offered to tax return.
Okay. Yeah. Rumki, if I was to come to you, looking at the overall initiatives that were rolled out in this budget, when she started speaking at the beginning of her speech, it did seem largely like this was a Bihar-focused budget, right? And of course, Bihar is the only state that's going to the polls this year. So all the initiatives seem directed towards the Bihar. Would you agree with that, and or do you think that this was needed for a state like Bihar? Some of the initiatives that you rolled out.
Clearly, there was quite a few announcements that were that kind of focused on Bihar, but that kind of tells you that I think the government wants to have a very inclusive budget. There are many states who are lagging behind in the path of growth, and you can see many of the states vying to be $1 trillion or be a bigger part of the growing pie of GDP. There are some states that need support, and I think Bihar is one of them, and the government acknowledges it. So quite a few there, and I guess given the fact that the state is resource rich, it requires a lot of handholding in terms so that it can actually match up with the speed with the neighboring states that it has. So I think we can say that the government is focusing on some of the states that require that kind of help.
Okay. And the capex of 10.18 lakh crores that she announced and 4.4% of GDP for FY26, is that adequate to keep the government on the path of growth to their goal of Viksit Bharat by 2047?
Interestingly, what we noticed that even though fiscal deficit, the allocation that the government made towards capex was not clearly called out in this budget, what they did call out that they need more state participation. So they gave those incentives, interest-free loans to the states. Then they called out on public-private partnership. All this is now the government is saying that we have heavy lifted the requirement of capex. Now the state should step in, the private sector should step in. Now infrastructure is a lucrative investments sector. For 4-5 years back, there was no FDI flowing into the sector. Now that sector accounts for 4% of the total FDI. That tells you that the sector is now becoming lucrative, and now more players should come in, and it's not the responsibility of the center alone. So, but again, this year we did lag on the amount of spend that was required to 11.11 to 10.39. So if you see the next year's target is 11.21 lakh crore. So that is about 10% increase from this year's fiscal year's achievement. So there is a push, but it doesn't mean that it has pulled its foot off the pedal. It is trying, but it's now trying to make sure that everyone participates.
Okay. And also on, if I was to bring Hardik in here, on the indirect tax side, with the changes that she's made in basic customs duty on some of the items, especially in electronics and telecom, in these areas. If I was to take a consumer standpoint here, how do you see it impacting, what industries, mobile phones, televisions? Do you see any direct impact on that?
Yeah, it's too early to say, but of course, with certain rate rationalization around the TV panels and all, I think the consumer industry, that is a consumer business, particularly on the electronics, should see some positive impact. And as far as the telecom is concerned, I think there was a bit of dispute around classification for the products, and for which now the rates has been rationalized to avoid any disputes and litigation. So overall, and as Easwaran rightly said, is that I think other than consumer, if you see, a lot of push has been towards renewables for clean energy, whereby the rates for solar, for EV manufacturing, the rates have been rationalized and reduced. Many of these products have become exempted. So and critical minerals, where we have a little bit of challenge, the rates have been reduced. So overall, we see a lot of push towards the clean energy goal and moving towards renewable.
Right. And Easwaran, on the manufacturing side, do you think enough incentives? And of course, I think there was a lot of announcements for power as well, in terms of nuclear power, 100 gigawatts of nuclear power to be set up. So all of this is on track?
So if you really look at it, our demand for 2047 is roughly about 710, 720 gigawatt, right, as per projections. So if you really look at it, we are talking about 1/7 of the demand coming up through this
2033.
2033, and possibly maybe, let's say, 1/6 will come up as we go by if these are successful. So the focus has been on two things, right, from a manufacturing standpoint. One is to really ensure that we are able to stay competitive with regard to logistics, power, and other dimensions which are enablers. Second one is to just continue from what Hardik said. Everywhere they're focused on the value chain. See, our biggest constraint so far has been we have been addressing pockets of demand. Take semiconductor, we did one part of the value chain, we eliminated equipment, materials, chemicals from the PLI. So what this has done is that, be it in terms of rationalization of rates, or for that matter, setting up the national manufacturing mission or the exports mission, I think the whole intent has been to ensure that the ecosystem is covered, which I think is good because India has to captivate both the revenue pool as well as the profit pool. Otherwise, your GVC participation will not be competitive. So that I think is a good one. But to the point that you started with, I think one expectation would have been to roll out PLI to a number of other sectors, which possibly is not the case right now.
Yeah, I mean, she did mention AI in this budget, because that in recent times we've had a lot of news around AI and how China managed to develop their own AI DeepSeek at a tenth or even a hundredth of the cost of what ChatGPT and Gemini and all the others did, and also for skilling. So just to quickly wrap up, because we just have like a couple of minutes left, how would each one of you, and I would just go around the panel over here, starting with Sudhakar and then Rumki. How would you rate this budget of Sitharaman's? Sudhakar.
See, I think personally, I still believe that while it's great to increase the threshold to 12 lakhs from an exemption standpoint and then change the rates. But normally, if you see what other countries are doing, several other countries are doing, right? The rate they keep is to a considerable extent aligned with what will be their per capita income they have in that country and things like that. So for us, I would still believe that while 12 lakhs is a very populous means, I still feel that how are we going to dent, who is going to pay this 100,000 crores so that it can accelerate to the government. So that is on that one point, I'm keeping my fingers crossed. Having said this, if this is going to be treated as an investment by the government in the people, who is for India, I think people are its assets, right? If the view is going to be that this is an investment by the government in its people who are in the prime age to contribute for its productivity, then that would be the right call. So I would somewhere between 6 to 7 on a scale of 10 for this budget, if that answers your question.
Yeah. Okay. Rumki, how would you look at this budget? Populist measures. Yeah.
As an economist, our expectations was to address inflation, employment, skilling, then consumption boosting. So I think all those points have been taken, even exports. So I would probably rate in all these, I think I'll rate it very high, 8. The only thing that we were expecting the capex spending to be a lot more diversified and a lot more higher. That is where probably the government would lose out. But otherwise, I think I would rate it as 8 out of 10 or 9 out of 10.
Okay, right. Hardik, how would you rate this budget?
No, I think as an indirect tax specialist, I think all those points in terms of bringing clarity, compliance and enforcement framework, rate rationalization to promote Make in India, and to give a boost to the manufacturing and exports, and even considering certain aspects for like healthcare, overall seems to be a balanced budget. And I would not sure how can I rate it, but overall I feel it's a good budget and quite a balanced budget.
Right. Thanks, Hardik. Easwaran?
I would say, considering all factors and taking the income tax out of it, I would say it's an 8 out of 10. Rated 8 because there is continuity of everything that has happened in the last budget. So there is obviously continuity. The only area where I feel that the two that I feel is we didn't add a lot of emerging sectors into the budget in terms of acceleration, which I think would have been critical, especially from an overall value chain perspective. So I would say it's more like an 8 out of 10.
Okay. And Jimit, your take on the budget, finally.
See, I would say the good part about it is there was no negative surprises, which actually, as Easwaran mentioned, that gives a good thing that there was stability, no negative surprises. I would have expected, the wide expectation that there would have been more boost to the manufacturing, some incentives which were going to be proposed. Maybe keeping fingers crossed, maybe if you see from a corporate tax point, there were not very significant changes except some of the procedural lacunas which are fixed and some immediate procedural changes regarding TDS, etc. We hope the next bill, the next week, in which they are going to bring the income tax bill, there would be reformative measures which will give us a boost to growth. Considering that fact, I think so. It's quite a balanced budget. I would say 7 to 8 out of 10.
Great. Okay. And on that note, as always, I'd like to thank this esteemed panel from Deloitte for coming here and giving their thoughts on the budget and breaking it down for us. I think as always, it's been a pleasure having you on financialexpress.com. Thank you so much for joining me.
Thank you.
Thank you.
Thank you.
Bye-bye.
Bye.